back to another episode of the Travillian Next podcast. I'm really excited for our guest today. We have Chuck Williams, founder, chairman, and CEO of Northpointe Bank, who recently completed their IPO successfully in January, which was the largest bank IPO in nearly 8 years. Chuck, welcome, and thanks for joining the podcast today.
Thank you, Michael. Glad to be here.
There's a lot I want to get into with you today, Chuck, but I wanted to start, in the publicly traded world, Northpointe, obviously, you're just entering, newer name. I thought it'd be really a good background of yourself and the bank would be a helpful starting point before we dive into some specific questions.
Yeah, that'd be great. Obviously, I'm Chuck Williams, founder of Northpointe Bank. My background, you can look at it, it's hard to admit and even harder to believe. I've been at this for 42 years. Grew up, grew up in Lansing, Michigan, so I'm a Michigan native. And been in banking all my life. Started at Michigan National back in 1983 and had a successful career at some local banks and got had some childish enthusiasm and a wild hair. I was 38 years old and started asking around, how do you start a bank? And fell in with some good people, at the time. And I think we started in 1997. It took a couple of years. We got off the ground in May of 99. And, here we are, 25, 26 years. I guess it's going to be 26. Our anniversary's coming up May 20th. So we started off as a community bank, still our community bank, but we started off as a community bank, really focusing on the residential real estate market in Michigan, Ohio, Indiana. And that served us really well. We were a really high-performing bank in the early 2000s. And then the financial crisis hit in 2007, 8, and 9. And that business kind of went by the wayside, what we were doing. So we had to reinvent ourselves at that time. And coming out of that, I had a local mortgage company owner called me and said, "Have you ever been in the warehouse lending business?" I said, "No, but we're really not doing anything productive now. So, tell me more about it." And that's how our warehouse business got kicked off. And we spent the entire year of 2009 developing that program, writing the software. We had a great crew taking care of all of that. And then met Dave Christo, who runs our program still today. We started off, with a few deals here and there. You fast forward to today, we're over 150 billion that we funded in that space. So along the same time, in 2012, I think it was, we kicked off a formal residential real estate program. We became affiliated with Fannie and Freddie and some different investors at that time. And fast forward, through today, we've been really successful. We have 30 LPOs across the country. Over 100 agents doing some great work in that space. And so that's been the development, of the bank over the years. And we can get into more of the IPO and what happened there. So that's a quick background of my background and just a quick overview, of the bank. So Mike, I'll leave it to you.
Yeah. No, it's a great starting point, and there's a lot to obviously a lot of those elements in growth I imagine factored into the decision to eventually go public. But maybe if we just start, I wanted to talk about the pandemic, right? It's an interesting handful of years to have as your years before you decide to become a publicly traded bank, right? What were a couple things that you felt the company really advanced on during that time period, which positioned you well to kind of get into that decision of going or not going public in over the course of 24 and into early 25?
Yeah. So we were set up. I mean, it was perfect. It was perfect timing for us. We had the infrastructure set up in both the real, the retail space, and the warehouse space. So when the pandemic hit, again, it was, I know it was bad timing for everything in the general public, but for us, with rates coming down and whatnot, we had the staff, the infrastructure to really excel during that time. So in 2020 and 2021, we just had fantastic years, over 100 million net income, which is it was just just great for us. So um, yeah, and then 22, 23, and 24 were rebuilding years for us. We had to, what I would call, everybody looks at it as rates are so much higher today, but I would call it just the new norm. And so one could argue that there's higher rates today, but if you just look at general history, because we had low rates for so long, and then 2021 hit, and then it went even lower. You could look at these times as kind of a high rate environment, but as I was mentioning, historically this is what I would call normal, and we had to adjust our expenses to operate, in this, in what I would call a normal, real estate market. So
Yeah.
that's what happened, for us, during the pandemic.
Yeah, I've come to hate the word normal because I feel like it's so overused, and we live in a world now where the curve is flat or inverted, equity and bond markets are up on the same day, and it's like all this stuff is happening. None of it feels very normal. But kind of transitioning to my next question, which is, in this world where normal is so hard to chase down, like how do you kind of
Yeah.
get your board around and make a decision on to go or not go public? I imagine it was probably an element that you were talking about for a long time, but the actual push to shove moment probably was a lot faster than people think. But I'd love to, if you could let us into that decision process a little bit, and what you were thinking, because the timing it ended up being a bit trickier in hindsight than I think we probably all realized when you guys decided to move forward. But what can you share about that decision making process, and how you guys finalized on charging forward with the IPO?
Yes. Uh, it was a long time in the making. I can go back to 2019 and even in 2020 that we were thinking about it, and we were building the infrastructure to be a public company, even before the pandemic. And then a pandemic hit, and there was so much going on and so much uncertainty and whatnot. So, we really didn't think about it much during 2021. It was just all, hey, how do we handle this increased volume and keep building our infrastructure and those sorts of things. So, although we were kind of what I would call on the same track of becoming a public company, during those years, it really wasn't the focus. And then 2022 hit, and everything kind of changed. Rates increased, very rapidly, and so then we again, decided to pause, any thoughts of being a public entity. And then 2023, we started to think a little bit more about it. And then 2024 is, again, we were already planning the infrastructure. So then it was just, we felt like the new administration and everything was the timing, it wasn't really market timing, at all. It was, the time was right for us to raise additional capital. We were in a growth mode, and our programs are, um, we travel down the middle of the road in rate cycles, so we think that we can excel in any environment. And so it just felt right in the fall of 24 to take a shot at it, and yeah, it was very successful. In the middle of February of this year.
Yeah, yeah. Well, congratulations on getting that completed. I think the lesson I take from it is what you said that resonates with me is the timing was right for us. After spending a decade and a half studying markets, it's so hard to time markets, and it's not like these are flip switches, right? Like you decide to go public and the next day you're on the Nasdaq. Like
Yeah.
there's a process. If you have a good strategic plan and an idea of what you need the capital for, and the other stuff tends to sort itself out over time. Like a good company will be valued more in the future, and that's kind of irrespective of any timing on an IPO or anything of that nature.
Yeah, and that's exactly right. We were working at it, like I said, for years, and so the timing, for us was right because we had a use for the additional capital, and we've had investors, since the beginning of the bank, 25 years. So we were able to achieve a little liquidity for
Mm-hmm.
people that wanted it, although nobody was really asking. But being in a privately held institution for that long, that brought them some potential liquidity, and so all these were the factors. Our growth, and yeah, the addition of the capital. It really had nothing to do with the timing. Obviously, you can't do it in terrible timing, but
Correct. Yeah.
uh,
Yes. Yeah.
and nobody could have predicted what happened after our IPO. So
Yeah. And on that point, I'd love to get into kind of some of Northpointe's growth opportunities because I mean, ultimately, you're going public, you're raising capital. There's stuff you guys are hoping to do, and you have your first quarter in the books as a publicly traded company, which congrats on. I know that can be no small feat, but how are you framing this growth opportunity to investors? What are the use of proceeds? Where are you looking to put some of this capital to work? And in an industry that I think is kind of struggling to tell good growth stories right now, what's Northpointe's growth story?
yeah, so we're growing in all phases, and we told the when we were doing out on our road show, if you look at the history of Northpointe, we've always had a growth model, and you can look back a number of years. So it wasn't anything that we had this new mousetrap, if you will, that we were gonna do all these new and exciting things. We've been a growth company for years, and we got to the point where we kept struggling, inside of our capital frame. That at the end of 2024, we were syndicating out a lot of loans. We were doing all these things. We had to put the brakes on, and it was what this doesn't make any sense. There's probably a different avenue, and that's what really prompted the IPO. So for us, it was nothing new. And when again we were doing our road shows, we were explaining that the growth in our MPP program and our residential real estate programs, our AIO, which is a first lien home equity loan, tied to a deposit sweep account. All these were growing, and it was very exciting. And I'm not really one to, I'm not really good at tapping on the brakes on stuff. And that's we're actually stomping on the brakes towards the end of 2024. So that led up to the IPO. We in the first quarter, we delivered exactly what we told everybody that we would. We had over 700 million in growth in our warehouse division, and that was we had told everybody 500 or 600 million. So we overachieved there. Earnings, we were better than our forecast, and for us, because we're kind of laser focused on the warehouse business and some other, the distributive retail, we're going to get our share, in that. The warehouse program, that what separates us, I think, from, I think I know, from other institutions is, we are focused, on that business. It's not a side business for us. We're focused on that business. We bring real value to our clients. We get in, we try to figure out, how we can, better serve them and how they can execute better. And, that every one of our clients knows that they can call the CEO if they have an issue. We're not a big box store. That's one of the great things about our organization is we're a very flat organization. I'll go answer the phones at the front desk if need be, and everybody understands in this organization. There's nobody in an Ivy Tower So that's the value that we bring to our clients, and that's the value that we try to discover, and how we can help our clients build. So there's always, whether it's a $7.5 trillion market, whether it's a $2.5 trillion market, we feel we can grow in any environment by, giving superior service, having superior software. Our tech stack is second to none, in that space. So our growth story is not necessarily, oh, the market has to be growing. Our growth story is bringing value to our clients, and that's how we've grown, and that's how we're flipping the script already in the first half of 2025 to, the market isn't growing per se, but our, growth is, we're able to, get out there, tell our story more, and people are excited about it, and the numbers prove it.
Yeah. Well, that's great, and I kind of have this thing I always say that the bank growth can be kind of episodic and reactive, right? Like most normal people or business owners don't wake up in the morning and think I'm going to switch banks today, right? It's usually in reaction to something, or they're not getting something, and so if you feel like you guys have good momentum and there's growth that's profitable for the bank, and this capital helps you do that, it makes a ton of sense. It's like, why leave that out on the table? It's especially now. I mean, it's pretty differentiating if you could profitably grow your balance sheet. There aren't a lot of banks that can really do that. Most right now are holding flat, shrinking. They have assets that are underwater. It's really not the strongest bank earnings environment. I think you see that reflected in valuation. So it's refreshing to hear that you guys kind of have those opportunities in front of you, and that this capital should help you, successfully, capitalize on those growth opportunities.
Yeah, again, we're staying the course, and yeah, we met our goals in the first quarter. I can't speak too much about what's going to happen, other than what's out there in the public market. But yeah, we haven't changed, and yeah, so we're continuing to grow, and we feel there's runway there. And again, Mike, we tailor our business, not, that we have some special mousetrap or whatnot. It's relationships. We treat people like they'd like to be treated. We bring value through relationships, and I think that's refreshing, out in the market. And again, it's proven to be true.
Yeah. I wanted to double. You mentioned technology, and I want to go there. But before we do that, I wanted to double click on something and get your opinion, because I think you have a unique perspective on it. It's an interesting time for banks in the mortgage business, right? I would say most banks are retreating. Some have exited. Obviously, this is your warehouse. Is not. Some of the exiting's been more like traditional, gain on sale mortgage, like direct, like lending type models. But nonetheless, I think it's a very interesting time for banks and mortgage businesses. And there's been a lot of questions about kind of scale, origination, servicing. What's the right path moving forward? I was just wondering, do you have an opinion on that? And clearly the warehouse business has been good to you guys, but what's kind of your overall view of the mortgage business, and how banks can capitalize and not, and where the risks kind of embedded are in that business for banks today?
Yeah, so we look at it as, there's a certain margin, that you have to operate, in. And so let's take the boom years. I'll just throw out some numbers. These aren't accurate, but you'll get the sense. So if it was 4% and everybody could make money in 20 and 21, let's just say today it's 2.5 to 3%. So after all of your expenses, there has to be something left to be profitable, right? And so the challenge is for any independent mortgage company or bank is to operate, inside of that expense structure. And that's what we spent a great amount of time doing in 22, 23, and 24 is, working on the expense side, because you already know what the revenue is going to be, and you can get your share if you have, great professionals, which we do. So then it's just a matter of, adjusting expenses to operate, inside of that infrastructure. So we have always been, I'll say not 100%, let's just say 98% focused on the mortgage industry as a bank. And probably not many banks around that if they couldn't find any comparables for it. So I know there's not a ton around,
Right. Yeah. Yeah.
but we're very diversified, inside of the mortgage space with our warehouse, with servicing, with our distributive retail. We have a consumer direct channel. So if you take all of these business units, some are, some, are excelling during trying times or what I call normal times right now, or so inflationary periods, there's some of the units are doing better, and non-inflationary, some of the units do well. But overall, as a blend of being diversified inside of the mortgage space, we have traditionally done very well, and that's the story that we told during the IPO. Is we have effectively operated in any interest rate environment, and we think that's going to hold true going forward.
Yeah. I mean, that makes sense. And when some retreat, there are opportunities for others, right? And I imagine some of the software and technology investments you've made are pretty critical in some of that controlling cost part of the conversation. And on that, vein, I wanted to transition here. At Travillian, a lot of the work we do is focused on how strategy and talent kind of intersect and understanding that crossroads and how it creates value inside of banks and fintechs and others. And I wanted to start with a real simple question, but you have to. I imagine there was a lot of human capital spent on the IPO, and now that that's behind you, where are you investing in the team today, Chuck? Where are it risk, technology, lending? Is it business development? Like, where are you guys kind of actively growing your talent within the organization that stands out to you?
Yeah, so it's all over the board. You just mentioned all of them. So, we going forward, our tech stack is very important to us in all of our business units or channels. The management team, we have a fantastic management team already, but we're always looking to grow, and we're in a growth mode, as I mentioned, and so we can't stand pat. The old saying: you're either moving forward or you're moving backwards.
Yeah,
That
never
is,
standing still.
yeah, that is so true today. So we have to be on top of our game, both from a management perspective, uh, a tech perspective, watching, what's happening in the market, how we can, um, uh, move with different opportunities that are out there. We have a very entrepreneurial spirit, and when there's something new or something that we feel that can bring value to our clients, and it's more efficient for us, we sit around and we implement it. Like next week, we don't wait around for months analyzing and doing things. So we're very quick to adapt to the market. We're very quick to analyze technology. We're very quick to, hey, we need to, particularly now, we need this talent for our management team moving forward. So these are all the things that we're constantly analyzing and taking in, and it doesn't take us long to make the adjustments that are necessary to execute in a rapidly a rapidly paced market that we're in. We've got AI considerations. We've
Hmm.
got efficiency gains. Because if we're not gaining efficiency in the market, either through tech management and other things, the competition is, and they're going to outdo us, and we can't let that happen.
Yeah. No, I love that sentiment. My high school football coach always used to say, "You're either getting better or you're getting worse. You're never staying the same." Shout out to Coach Naughton. I doubt you're listening,
Yeah,
but it always stuck with me all these years later, and I think that it's just a very objectively true statement, and I appreciate the perspective of how you kind of manage that. I mean, you guys are making even like organizational investments. Like you have a chief innovation officer, which I think is an interesting role for a bank your size. You don't see every bank your size have that role. A lot of them just have maybe like a chief information officer or something of that nature, more traditional. Any technology initiatives you're working on right now that stand out as whether you think they could be, if successful, potentially pretty advantageous from a scale and cost savings perspective, or maybe pretty offensive in kind of your apparatus to capture new business or things of that nature. Anything exciting that you can share?
Yeah. So if you look at our tech stack, I'll start with the warehouse program. We developed our own software, in that space to better serve our clients, and so we think we have a world class tech stack, in that space. And our clients, I go out to our clients, all the time, and how are we doing here? What can we do better? And we get constant just compliments of the system. It's the best one out there. So it's just not me telling you, uh, on this broadcast that it's the best. Our clients, say the same thing. So, and that's ever evolving, and you have to keep up. So, that we're really proud of that software and where it's going and whatnot. And I can't share everything with you, but we're on. We know that technology is critical to cost savings and being more efficient. Because again, I'll say it again, if we're not doing it, our competition is. And so you can't just, you can't stand pat on the technology front, and we understand that. With that being said, we typically haven't been on the cutting edge. That was kind of, I think, a little bit of your question. What cutting edge stuff that we have. We adjust to the market, and we might not be the leader in, let's take AI for example, in the industry, but we're constantly looking at what's new, what's out there, what can we develop, what is better to outsource and bring that technology in. So these are all, again, things that we evaluate continually, on a daily basis.
Yeah. No, I mean, I totally understand. And that type of stuff's out there. I work with a bank that's running a parallel BSA AI driven technology solution right now that, if works and the regulators bless it, will be very beneficial to the bottom line longer term versus the amount of headcount they have doing that manually, more manually oriented today. So this type of stuff, it's not kind of out in the future. It's much closer than I think some people realize. But um, Chuck, this has been great. I really appreciate everything. I wanted to wrap up um, with just kind of a simplistic question about your career and your experience as a banker and growing. And it's uncertain times. It's been that way for a while. It's likely going to be that way for the foreseeable future. But time doesn't stop, right? You got to grow. You got to figure out ways to grow earnings and grow your business. What's maybe a lesson or two in your career that has helped you kind of manage that volatility and drive growth in a risk management business, which is, it's kind of the trick, right? Is risk managed or risk appropriate growth. Anything that stands out, any lessons learned or things that occurred that you could share as a parting gift to the audience here?
Yeah, your comment just makes me think of so many things that I don't even know where to begin. I think, over time and as you gain, more perspectives and experience and whatnot, is I would leave you with, don't get too high with the highs and too low with the lows. The bad, your troubling times, whatever you want to call it, and I'll use the pandemic. It was the worst of times for us as Americans, or worldwide, I guess. We had to, you know, do all the crazy things that we had to do, but for us as a business, it was great. So is that a terrible time? Is it a good time? Define that. And so I've been through. So I started my career, when interest rates were 21%, and to as low as 1 or 2% in 2021. So that's what you see over 42 years. So our communication, or my communication, with our team is, bad times, and I like Warren Buffett's, bad times don't last forever, and good times, or very successful times, I guess, if you're talking about the business segment, you you can't rest because you're in this great because this great time, because it all comes to an end. And so I would leave you with, yeah, don't get too high with the highs or too low with the lows, because neither one lasts very long. And so and again, it's funny, we started this conversation talking about normal. If you just live in the present, if you will, everything is fine.
Yeah.
Everybody's predicting what could happen, but you really have to live for today and what's happening in this environment, and execute in this environment. And you obviously have to plan for a lot of different things, but you could be successful just staying the course. And again, don't get too caught up in all the bad press that you read. Just pay attention to your people, pay attention to your clients, and good things will happen for you.
No, I love it, and it's a great sentiment to add on. Chuck, thank you very much for your time today. Northpointe Bank, ticker NPB. Check it out. It's been trading for a few months now. Chuck, thanks for joining us.
Thank you so much, Mike. I really appreciate it. Have a great day.